Welcome to Barchart's series of webinars designed to enlighten you about a variety of trading ideas and concepts, inform you of the features and tools Barchart provides related to these concepts, and offer some traders insight to help you make a more informed decision. Today's subject, mastering Fibonacci analysis. In the 13th century, an Italian mathematician formulated the Fibonacci sequence from teachings he had learned from Indian scholars, which today still influences modern mathematics. But centuries before Fibonacci, the Greeks were aware of this golden ratio that is found throughout nature and the physical world and was incorporated into their architecture and art. Now, for instance, a sunflower has 89 curves, 55 that are with the prevailing winds and 34 against. All three of these numbers are part of the Fibonacci sequence. Now, during the early part of the 1900s, during the birth of old school market analysis, chartists recognized that stocks tended to correct or pull back in ratios of about 1/3 to 2/3 of larger price movements. Now, it wasn't until the 70s, with the advent of computers, that technicians realized that these proportions were actually Fibonacci ratios. And today's algorithmic trading programs codes contain derivative aspects of the original Fibonacci sequence and the golden ratio. Hello, everyone. My name is John Rowland, Barchart's Senior Market Strategy, and I'm your host for today's session. And today we're going to look at how to apply Fibonacci ratios using retracements and extension drawing tools to proportionalize and segment price movements for the discovery of potential natural levels of support and resistance. Now, where price could be rejected or pause prior to advancing to the next Fibonacci level, or a continuation of the prevailing trend. Now, before we get to that, please welcome our moderator and Barchart's project director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I'm doing well, and yourself?
I'm great here. Thank you. Thank you for asking.
All right. I see a couple comments here. Yeah, I do like saying hello, Gene. So let's jump right into it, Gene, because I want to get to a lot of examples today. All right.
Sounds good, John. Thanks.
Okay, thanks. Just to remind you that today's session is for educational purposes only, and that decisions to buy, sell, hold, or trade securities, commodities, or other investments involve risk and are best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any losses or damages that you incur based on trading information or material that you receive through barchart.com and our services. All right. So Fibonacci, right? So the mathematician discovered this sequence of numbers. It's just a list of numbers that the next number in the sequence is the sum of the previous two numbers. But mathematicians discovered as the numbers get larger, they move closer to a given ratio. And this ratio becomes consistent as you move farther through the sequence. Now, that ratio is called the golden ratio. Sometimes it's called the golden mean, or even the divine ratio, and is the bedrock for modern day technical analysis of proportional analysis. And when applying Fibonacci percentages in terms of the retracement, we're going to concentrate on these percentages. Now, remember, a percentage is just a ratio times by 100. Now, there are some distinctions and characteristics of which ratios we want to focus on depending on if we're dissecting an uptrend or a downtrend. And for extensions, well, it's really about the strength of a trend. Strength of a trend, or the timing of our Fibonacci relationships. And also, when we talk about targeting, we can use these to determine realistic expectations. So why Fibonacci? Well, the golden rule is very pleasing to the human eye. But from a technical analysis standpoint, it's about pattern recognition in a world of random price action. And from an analytical perspective, it's the general acceptance and adaptation of this proportional analysis and segmenting price movement into a directional impulses and corrections. Now, this is the cornerstone of Elliott wave theory. And we're not going to spend time talking about Elliott wave theory, just the part of the Fibonacci's that can relate to Elliott wave theory. Now, this wide acceptance among traders and algorithmic trading programs. Now you think about it, they're all looking at the same data sets and their reactions or conclusions will be in concert. And then therefore, these Fibonacci levels become a self-fulfilling prophecy. Now for us, it's not the belief in these numbers, but that others do believe in them. Now in the book, The Art of War by Sun Tzu, I know I'm paraphrasing here, understand the tactics of your enemy, you can modify your own tactics and thereby succeed in winning battles. And that's what we're going to do. So what are the applications of Fibonacci? So again, as I mentioned, it is part of the Elliott wave theory. And this analysis is very subjective as it tries to aim to identify the length and time proportions in a wave series. Again, we're not going to spend a lot of time talking about waves, but this subjectivity should be considered when applying this type of analysis. So what do I mean by subjectivity? Well, that could be that depending on the length of time or the data set we're looking at, or choosing our swing highs and lows. And then also discovering the distinction of what could be an impulse or a correction in a primary trend or a corrective secondary wave. Now, this will help us, Fibonacci, and aid us in discovery of support and resistance levels. And when we combine it with other technical analysis, for instance, price structure or moving averages, Bollinger Bands, or other timely indicators, this is where Fibonacci shine as a conformational enhancement and increasing probabilities. But with every technical analysis, there is a caveat. And the caveat for Fibonacci's is that these percentage levels should not be looked at as levels, should be looked at as levels and not as absolute pinpoint values. Though, from my experience, you can encounter accurate price reactions on the intraday analysis level, but those price reactions might be fleeting and or only temporary. Okay. All right, so let's do this. All right, so I just jumped to the SPY here, And this is the S&P 500 ETF. And so let's first start, where do you find the Fibonacci tools on Barchart? So the first place you can look for them is under the toolbox. And I've opened the toolbox. You can see that we have different types of Fibonacci analysis. We're just going to concentrate on the retracement and extensions. Now, here's a little suggestion or advice. If you're going to use this type of analysis, or you're going to use these drawing tools, I would recommend that you turn on the snap mode. And what this does, it helps pinpoint when you're setting up your highs and lows of your Fibonacci ranges. Just makes it a lot easier to get very close to those numbers. Now, what are we going to do? Oh, and the other spot that we can find them is if you have a toolbox on your chart on the left here, it would be the second toolbox area, and you can open that up and you can see the Fibonacci levels. All right, so let's talk about retracement, or let's just talk about Fibonacci's in general. So what are we trying to achieve here? So what we're going to do is we want to connect price movement from, let's say, whatever time frame I want to look at, but I think the importance of a Fibonacci comes from a higher time frame. Now, again, it is subjective to the trader, what their goals and what time frames they like to work in. But I think somewhere along the line, a daily time frame should be part of your analysis. So what we're going to do is, what we want to do is connect price action and try to identify a dominant trend at the same time. So again, when we look at this chart here, it's pretty obvious to us that we're in a dominant uptrend. So what we want to do is we want to connect swing highs and swing lows. So what is a swing high, or what is a swing low? So I'll make it very simple for you. A swing low or a swing high is, well, a swing low is where price stops going down and starts going up. A swing high is where price goes up and stops going up and starts going down. Now, could you have little momentary ups and downs? Yes, you can, but we want to look at significant price movement. So if we look at this particular price action, our swing low would be here. So I've turned on the Fibonacci retracement tool, and I'm going to bring my cursor to that swing low. I'm going to left click, and then I'm just going to drag it to the right until I reach my swing high right there. And again, what's nice about the snap tool is it will go to the closest price. Now, the question always comes up is, do we use the absolute low and the absolute high, or do you use closing prices? And again, I don't think there's a right or wrong answer in that one. I think it's about your methodology. If you're going to use closing prices, make sure you carry that through all of your analysis and don't mix or match. In other words, using a low, absolute low, but then a closing high or something to that effect, all right? So let's look at what Fibonacci has done for us, right? So what it now is giving us these percentages or these levels where we can anticipate potential support or resistance. Now, if I'm drawing an uptrend, we always start, well, first of all, we always start on the left-hand side and we go from left to right. But if I'm drawing an uptrend, I want to start from low to high. And if I'm going to do a downtrend, I want to go from left to right, from high to low. Now, if I right-click on any one of the lines in my Fibonacci analysis, that will take me to the settings of Fibonacci. And so here what you can do is, if you know for a fact your high and your low, you could type in that price, be very precise. You could change the color, you can change the width of the lines, you can make the Fibonacci line solid, or you can make them dots, where you position the labels, show the labels, don't show the labels, and then our levels of percentages. So let's talk about this for a second here. So when we start looking at uptrends or bull markets, what we'll discover is that they have shallower retracements. So we're going to concentrate on those levels of retracements of, let's say, 23.6 and 38.2. When we talk about bear markets or downtrends, well, they tend to have deeper retracements. So we'll concentrate on that 61.8 and that 78.6 levels. Now, the 50% retracement is not a true Fibonacci percentage unless you count that first part of the sequencing, that 1, 2. But its acceptance makes it a viable level. So that's why we have it. So again, we'll look at these percentages as we go through some of our examples. All right, so what I did was I just looked at this October low from 2023 and then this high that was set in April. And then what did we say? Well, in bull markets tend to have shallower retracements. You can see that our price action retraced to that 23.6 level. Now, again, remember, it's not a precise number, but it's a level of where we can predict or anticipate some type of price action or reaction. And what we want to do here is, if we have a Fibonacci level, what we want to start doing is we want to start collecting evidence. Will this be a good level? And what we're going to do is we're going to look at other technical analysis. Now, one of the simplest pieces of information that we can look at in technical analysis is just price structure. In other words, old support or resistance, levels of where price has broken out of a range, things like that. So let's look at this from a technical, other than a Fibonacci technical aspect. So the first thing I want you to notice here is, notice that there is a void in price. This is called a gap. And gaps are origins of explosive moves, or this telling us there's an imbalance between buyers and sellers. Now, in candlestick theory, gaps are called windows, and windows are levels of support and resistance. So in this case, this gap would be a level of support, and it is right near our Fibonacci level. Another way we can start looking at a very simple tool would be something called a moving average. So I just turned on one of our bar chart templates that has some moving averages, and you can see that our Fibonacci level comes relatively close on that particular day to our 100-day moving average. Again, not a precise element, but moving averages can act as levels of support and resistance. So there could be other technical analysis we could look at. So in this case, I have the RSI down here on the bottom. Now, this did go into what I would consider a classic oversold category for the RSI, but we got a nice V bottom at that level. In other words, price reacted to our Fibonacci level, and our technical analysis here is confirming this change in our momentum. And then there are other technical tools, like tools that look at volatility, and that would be something like a Bollinger Band. And again, notice that here we see where our bands have narrowed, and now our bands are wide. Whoops, a little refresh here. And that this Bollinger Band piercing occurred in confluence with our Fibonacci line. Now, I want you to notice here, though, if you're not familiar with Bollinger Bands, we do have several webinars on those as well. But usually when you get outside the band and then price returns inside it, it's something called a mean reversion. And notice, though, we did get a very quick retest, and that retest was also our Fibonacci level. So this is the process of how we're going to use Fibonacci's. We want to find this collective evidence clustered around these levels. Now let's go back to that higher time frame, and let's talk about this little minor correction here, right? So this one was very easy for us to see, but there are, and again, this is part of the subjectivity of Fibonacci. So here we have a little bit of a minor correction. I would call this more of a basing action than a correction. But this is one of the mistakes of Fibonacci. Notice this basing action occurred between the 50% and the 38%. But think about this. This basing action occurred before that peak high price, right? In other words, this basing action occurred before we could even draw these levels. And that's kind of the mistake about Fibonacci. If you are trading or you're doing Fibonacci analysis on some of your charts and you see this type of action, in other words, pre-Fibonacci reaction levels before we actually can draw them, then I would say that this chart or this market is conducive to Fibonacci analysis. In other words, it's Fibonacci friendly, and that's really kind of important. So we'll come back to this in a moment, but then let's talk about another aspect. And this is this subjectivity of Fibonacci, something called fractal nature. In other words, when we look at Fibonacci price action and we look at, let's say in this case, we're looking at a retracement of 23.6%. Fractal recognition tells us that we could see the similar patterns as we move up in time frame or we move down in time frame. So let's move down in time frame, and I'm going to go to a 1 month data set, and this is a 60-minute time frame. And notice that we do have this upward bias or upward price action. We could call that an uptrend, right? And again, let's use our Fibonacci retracements. And here's our swing low or price stop going down. And there's our swing high. And notice our retracement in this uptrend is that 23.6. This would be that fractal nature of Fibonacci, that golden ratio that is throughout all of nature and in financial analysis or market analysis throughout all time frames. So again, let's talk about other technical analysis in this case. Well, let's go to our RSI. Now I'm going to go to this template. Now this template starts out of the daily, but I'll jump back down to the monthly. And here is where we touched our 23%. And now here we can see RSI again is not oversold, but in RSI theory, when you're in a dominant trend in terms of, let's say, an uptrend, here that the RSI has a tendency to hold that 50% level, and that is a good sign of a strong uptrend. And again, we have a webinar on RSIs that you can watch when we discuss this, how this RSI can shift. So you can see here that it held the 50% level as we encountered our Fibonacci. Now, again, let's go down to our Bollinger Bands, that volatility aspect of it. Again, I need to go to that 60-minute time frame. Our Bollinger Bands are narrow here, so not a great indication, but again, that piercing outside the Bollinger Bands lined up with our Fibonacci number. Again, this cluster of evidence that falls near or in proximity of a Fibonacci analysis. All right, so let's talk about extensions, and this is where we'll go back to that. We'll look at this in a second. Now, let me do this here. Let's get rid of that. Hang on. So I just right-click here, and then I can just delete that study. All right, so I'm going to leave our retracement here, but I'm going to go and add a extension. So let's do two extensions here. So the first extension I want to do is from the same swing high and swing low. Now, when we do the extension here, what we want to do is, again, look for that extended price movement, but we also want to look for that reversal of that correction move. So we need 3 points to do that. And so this can be a little tricky if the first time you're attempting to do this. So I'm going to click on extensions, and I'm going to left click, hold, and drag from swing low to swing high, or swing high to swing low. And then once I achieve that, just like I would do on a retracement, I'm going to left click release and then drag my cursor to that corrective wave movement. And so that would be right there, and then left click to set it. Now, what this will do is it will create extension moves. In other words, in proportional analysis, this is a value in relationship to this last leg, this last wave. So let's talk about that. So in uptrends, or uptrends that are weakening, right, they will struggle to get to this 61.8 value. And usually when they get there, they will react to it. But from a risk reward ratio, as I'm setting trades, if I'm looking at long trades, I think we can use this as a realistic target to do our risk reward analysis. Now, we could see a higher price action. That is what we want. But in terms of being conservative, in terms of setting a realistic target, this 61.8 is a very realistic target, depending on our trend. Now, strong bull markets or strong uptrends will usually pause at the 61.8 level before moving on to the 100, the 127, and the 161. The stronger the trend, the more probable we're going to see the higher levels. So in this case, a very realistic target based on this price action would be somewhere around 565. The other thing you have to take into consider is the time it took to get that last leg. Usually it's somewhere equal to, and sometimes maybe even greater than, especially when we're looking at those greater extensions. But let's go back to this correction, right? This little kind of basing action. Let's do a Fibonacci extension based on that. Hang on. And again, in strong uptrends, right, that 61 target is very achievable, right? And that's exactly what we saw here. And notice that our 100%, or the equal length of this movement, did come pretty close to where we stalled out in one of our slower time frame correction levels. Now, what we want to start doing is, as we start dissecting these waves or these legs, if we start seeing our extensions starting to line up together or in relative close proximity, then that would give us a greater onus when price gets to those levels. Now these two don't really line up very close, but let's do this. Let's go back to our lower time frame and do an extension based on this price movement. And notice today's price action fell right at that 61.8 level, right in that same ballpark. Now, we could look at other technical analysis. For instance, we could look at former resistance or trend lines if we had trend lines above us, but because we're making all-time highs, we have no data, no other technical analysis. Now, what I could look at is for Bollinger Bands or RSIs to see if we were, were overbought or in an extended price wave, and you can see that we're currently now entering into the overbought condition. But what did I say to you? A strong bull market will tend to pause first at the 61.8 level and then continue on. But now let's look at this from that big picture. And what do we see? Well, what we notice is that some of these shorter term extensions are now lining up with our higher time frame extensions. And the first one I notice is that 100% runs right with our 127. So again, if I was looking at an area for a potential target or an area where I want to do some kind of profit-taking adjustments or risk management adjustments, then I would have to respect those ones, especially if I get into an overbought or oversold condition. And notice that our 168 lines up with our 61.8 of our much higher time frame. Okay. All right, so that's uptrends, and let's go to downtrends. And here's Tesla. So again, what are we trying to achieve right here? Well, first of all, we just kind of want to connect price movements, these swing highs and swing lows. So let's go back and we're going to go in here and I'm going to look at my Fibonacci's and I'm going to go to my Fibonacci retracement. And again, here is my swing high. And again, left to right, but from high to low. And there's my swing low. And what did we say? Well, in downtrending markets or in bear markets, we tend to see deeper retracements. And you can see in this case, we did ultimately get to very close to that 78.6%. But can a chart become Fibonacci friendly, or Fibonacci levels, can they act as levels of support and resistance, regardless if I'm in an uptrend or a downtrend? And notice how each one of these levels, price paused, based, and then continue to move. So as one level gets vanquished, then the next one comes probable. As price holds a level, the next one becomes probable. And you can see how it did that multiple times. So let's look at this price action. Again, there's our swing high. Here's our swing low. Again, a very Fibonacci friendly market, right? A lot of reactions, right? Almost pinpoint action here at these levels. And again, bear market, a lot deeper penetration. All right, so let's talk about extensions, right? So let's go down to a little bit lower time frame. Well, not that low, okay? And what do I see here, right? Again, let's talk about, just technical analysis in general. All right, I see a downtrending market where the market comes and makes a low, it bounces, and then, we find this low level a couple of times. But if I wanted to ride that trend train, right, as price breaks this level low, now this would, in Elliott wave theory, this would be kind of the beginning of what we call an ABC price wave. So how far could this wave go? How far could price extend based on previous price action? And so what we can do is we go in and draw our extensions. And again, just for time's sake, I already did that. So I took, here's our high, there's that low, there's that correction, and then there's my extensions. So the sell signal, right, that we were looking for when we broke that low would be price violating that 161.8 level. And where would the target be? Again, that target would be that 100% of this last leg, that A, B, C leg. Now, that would be a target for a short trade. But could this also be a potential target for a long trade? Yeah, it could. So what would we want to do? We would want to collectively start finding other evidence to tell us that this would be a good level of support. Now, what I have here is I do have a red line that was originally drawn, and that goes back here. But notice just below this red line, we have this little gap there. So I'll just put that red line on that gap, and let's just see how that lines up with, excuse me, this, yep, this little gap, right, excuse me. There's the gap. I was wrong red line. That's why I have it. There it is. Yep, there's this little gap right here. And that would be a good technical structure level. The other thing I could look at would again be those more timely technical tools. For instance, here is our RSI. Again, there is that level where we tested that 100% extension, and here more of a classic RSI oversold, and then out of the oversold, which could give you a potential buy signal. And then from a volatility standpoint, our Bollinger Bands, again, beautiful whole candle outside, piercing outside, and then the next candle in, that would be that signal for that mean reversion. So again, that cluster of evidence, in this case, of the last ABC wave of this much greater down trend. All right. So another question that I get a lot is, can we use Fibonacci's in other markets? And yeah, again, this is the mystique of Fibonacci's. It works in any market that has types of price action. Now, there are some markets that might not be Fibonacci friendly, and I would say those are usually markets that aren't actively trading, or that have very low volume, or kind of stagnant. In other words, they're not really moving. There's not a lot of volatility into them. But let's go to, let's say, Bitcoin. And just full disclosure, I don't own any Bitcoins. I do have a very small Bitcoin ETF position. But when I do my show on Fridays, our Market and Close show, we do discuss Bitcoin, and I have noticed that Bitcoin is very Fibonacci friendly. In other words, when I start drawing these Fibonacci levels, no matter what time frames I'm looking at, is that the levels of support and resistance that naturally occur in the chart line up very well with our Fibonacci levels. And again, for time's sake, I just drew this one, and I'm going back to November of 22 and to this peak high. Again, large data field in terms of my analysis. And again, notice again how Fibonacci friendly this chart is, that where we can see where price clustered, right? Even before the peak was created, right? This cluster here, right around the 50% retracement. We did, at that point, we didn't know that was a 50% retracement, where price based right around the 38%. Again, this is kind of that mystique of Fibonacci. Now, here we can see multiple tests at the 23 level, and then a little bit of a piercing below that. Let's go from, let's say, another time frame. Let's do from this correction here and do another extent retracement. So let's take this low and the same high, and there we go. Right on top of it. And so because we can't distinguish this, then let's do this, right click, and let's just change the color on this one so we can see it. And what do we see? Let's go from a 2-year data frame to, let's say, a 6-month data frame. And so here we can see, right, there's those red retracements based on this swing low. And notice again, our 23 and our 38 acting at levels of both support and levels of resistance. Now we did get a piercing down here, close to that 50% retracement. Again, I think it would be very easy for us to look at some technical analysis in terms of RSIs. Again, there's a theory that says in uptrending markets, strong uptrending markets, that RSI will go below 40, and that is a very strong sign of an uptrend, even though we could say this is probably more of a sideways action. Again, if I look at my Bollinger Bands, you know, multiple piercings at that very same level. So again, using this Fibonacci time frame. Now, again, let's look at this in terms of a fractal relationship. So we've looked at, you know, over, let's say, the last 3 years. We've looked at over the last, let's say, 4 to 6 months. Let's go down to, again, a smaller time frame. Again, I'm down into a 1-month data set, and I'm a 60-minute time frame. And what do we see here? Well, I see, you know, a price action, right? A swing high and swing low, where we have a kind of a correction or pausing or basing action. So let's do both our Fibonacci retracement on this one. There is our retracement. And again, downtrending price actions tend to have deeper retracements. And notice that today's action came right to that 61.8%. But prior to that, where did it pause, right? Again, notice that these levels occurred before we actually did this analysis, right? Or this swing high to this swing low. Now let's do it from an extension standpoint, right? So let's do this swing high to this swing low, release, and there's our correction. Let's get it right there. Not very close, but in the relatively the same ballpark. In terms of Bitcoin, a difference of, you know, 66,187 and 65,940 in terms of what the value of Bitcoin is, you know, percentage-wise is not that much different. But again, notice if we look at price structure in terms of where we might anticipate support, that would be right in this line here, again, with that Fibonacci extension. And again, if I did some more technical analysis, again, I'm going to have to drop back down, a really nice oversold RSI, and from our Bollinger Band standpoint, again, I have to go to that lower time frame, just on the edge of that Bollinger Band. Okay, so again, recognizing a cluster of evidence based on the different time frames. All right, so let's do this. Where am I in time, Gene? Okay, good. I'm right on time. I see a few of your questions here. Let me see if I can answer a couple questions. We'll take a pause, and then we'll do one or more analysis. So let's do this here. Let me can see your questions.
While John is checking questions, I just want to remind everybody out there that our charts with all of these different Fibonacci tools are available pretty much on any level of membership that you choose to use with Barchart. If you go with a Plus or Premier membership, all of these charts and all of your specific settings on them, we save them so that when you come back to your chart that they're there. If you haven't tried Plus or Premier, there are things outside of the Fibonacci retracements that you can also use all sorts of analysis tools. So we offer a free 30-day trial. If you care to try any of those out, just give support a heads up, support@barchart.com. Thanks.
Okay, so we get a question here: is when do you use retracements or when do you use extensions? Again, that would be based on what type of trend analysis we're doing, right? Are we breaking out of a range? I'm going to look at extensions. If I'm just made a swing high and now market is correcting, I'm going to look for that, how deep I think that correction is going to be, or vice versa on an up or downtrend. So again, the selection of the tool would be in concert or with the time frame and the trend of price action that you are looking at. But in this example of the Bitcoin, I showed you how to use both the tool for the same price action. So there was a question: is why did I use the current high in the S&P at 530.43? And we'll go back to the S&P in a moment. But I think what we were showing and was demonstrating is, where did price stop going up and start going down? That first correction, and that's why we used a retracement. But we could use that. We could use that now, especially if price does what? Corrects from this high. Certainly, we could use it for an extension, and I showed you that as well. So the question here is that it says that I'm using 6-month or daily Fibonacci's. That means, is it not effective, say, for in the weeks or in lower time frames, let's say day trading? Again, Fibonacci analysis is fractal. In other words, you can use it in all time frames, and what you will see is a lot of times is the higher time frame Fibonacci analysis will line up with the daily analysis, which will line up with the intraday. And I showed that example in the S&P, that retracement of 23%, what happened both in the 60-minute time frame as well in the daily time frame in terms of that greater trend. So yeah, so you can use it in all time frames. Richard, stay with me. I'm going to show you a little trick here in a second. So Sammy asks, why do I use, let's say, a moving average or an RSI, or, why do I not use a different moving average? Again, it depends on the trader and it depends on what tools you believe in. So again, we're just trying to look for that confluence of evidence. And if you're using a 5 moving average, at a lower time frame, then that's hopefully your Fibonacci's will line up with it. If you're looking at, a daily time frame over a year or so, and you're using a 20-day moving average, well, what does 20 days represent? Well, that represents about 1 month worth of trading. Now, I know some traders will use Fibonacci sequence numbers in their moving average. Instead of using a 20, they'll use a 21. The turtles look for 55-day breakouts for their one of their tools. Matt asks, can you show a not friendly fib? Matt, you'll just figure it out. Just trust me. It's usually, I'll give you a couple examples. Like if you're trading a commodity or a futures market and it's during the rollover period, and depending on what chart you're using, if you're using an adjusted continuation chart, then your fibs are going to be way off. If you're using a contract specific chart, then your fibs will be a little bit more reliable. Just a market that just is not moving, right? It's not trading. There's no volatility. You're not going to get those in terms of Elliott wave theory, right? And you're getting those waves, right? That impulse correction. That's kind of what we want to see, right? All right. Dominic asks, why does it matter if you draw high to low or low to high? Dominic, if you want to do it the other way, that's fine. But think about it. If you drew uptrending retracement from high to low, then your retracements are going to be in reverse, right? So that wouldn't give you really that great analysis that you might want to do, right? Okay. All right, so let's do this, and this is for Richard. So one of the cool things we can do is when price returns to one of our Fibonacci levels, and I'm going to use that level as on that day. I'm going to call that my day of action, right? I'm going to enter a trade. I'm going to either buy, I'm either going to sell, depending on whatever analysis that I've done, or depending on the risk analysis that I've done. What we can do is there is another piece of information that we can use. And let me go into, again, my templates here. Under Barchart templates. And down here we have a 13 EMA, exponential moving average. Again, 13 being a Fibonacci number. And pivots, or what we call the floor trader pivots. So I'm going to go to that chart. Now what this does is this template here. Now there's a lot going on here, but let's see if we can kind of clarify what was going on here. It's going to give you the pivot for the day, which is this black line, 3 layers of support and 3 layers of resistance based on yesterday's price action and where today's price. And you're also going to get an RSI. Now notice that this is a 5-day, 30-minute time frame. And then here's your 13 EMA. In other words, a 13 30-minute moving average. And what you can do is, as price reaches one of these Fibonacci levels, depending on what you want to do, what you're going to be surprised to find is that one of your pivots, either your support pivot or your resistance pivot, is going to line up with your Fibonacci. And it's going to happen more times than not, certainly in those Fibonacci friendly markets. And again, look at today's S&P price action. The high that was created this morning on this gap up is our floor traders' third resistance. Very strong price movement, but our third resistance, which lines up with that very easy, attainable breakout of our last leg target of 61.8. So if you had taken that breakout trade, or you had been long anticipation of the market breaking out, this would be a clear sign to me, hey, I'm going to do some kind of risk management, either to take profits or to move my stops. Now, in strong uptrending markets, we said the market tends to pause at this value before proceeding on. So where could be the next level? That 550 level. So what I would be doing here is watching to see if the next impulse will take us to that 100% level, or maybe even beyond. But in terms of our retracement, now the question is, why wouldn't you use this high? Well, let's look at that. And so if we're going to do a retracement, right, we want to find our swing low. And this, now we're making the assumption that this is going to be our swing high. Right? So where would we look for support? Well, right at the bottom of that green candle is our 23.6, right at where our 13 moving average, in this case, the 60-minute time frame, is really close to our 38%. So those would be levels that I would be looking at. Notice how that also lines up today with those previous levels, or those floor traded resistance levels. Remember, in technical analysis, old resistance become new support. So that would be for today. Tomorrow would be another story, right? Tomorrow we're going to get new pivots, and again, we could do this same analysis. Now, these Fibonacci's, if we're going to make this assumption, are not going to change, right? But the floor trader pivots will, okay? So hopefully if that makes sense to you, Richard, okay? All right, so let's do this real quickly because we are getting close to the top of the hour. Some takeaways, right? The subjectivity of Fibonacci's, right? It depends on the time frame you're looking at. Depends on, are we looking at a dominant trend, or are we looking at that correction or that secondary wave inside of our dominant trend? But we also want to make sure that we use other technical analysis. We don't want to use these as standalone, right? We want to start adding other ones. So moving averages, gaps, previous levels of resistance, so previous levels of support, right? Previous Fibonacci numbers levels as well. We want to look at Fibonacci in multiple time frames again, and then we want to look for those confluences or clusters of levels on our multiple time frames. Look for that fractal response. In other words, if I'm seeing I'm in a correction phase at a daily time frame, and I've just had an impulse in a lower time frame, right? Let's see if that correction is the same ratio that we saw in the higher time frame. And again, I really want to focus on where I see a cluster of Fibonacci lines, especially those that align with my trend. Okay. So one final question is, could you use Fibonacci's as a way to find supply and demand? Yes, I think that is exactly what you should do. That would be what? Support, resistance, and structure all combined together, wouldn't it be, for those of you who know what supply and demand zones are? All right, so this was Gene saying that you do have a free trial membership for our Plus, our Premiers. And again, you can try this out for 30 days. Again, talking about trading, this is a very low risk trade. Matter of fact, this is a risk-free trade. So I don't know why you wouldn't give it a shot if you're not already one of our members. And again, I remind you of those for our Premier and Plus members. On Fridays, we have a more intimate session, which we look at market. It's called Market on Close. All right, so one final. So I did promise to get to a question that someone sent in, and I apologize, I forget your name, but the question is that subjectivity. Here is 3M, right? How do we define if this is an uptrend or a downtrend? Again, Fibonacci could help us define that. But I think if we looked at this trade, we could say that this is a market that has been trending downward, so it would be a downtrending market. But when trends change, there are two characteristics. We might start looking at something called a change in characteristics and a break of structure. Change in characteristics means that, you know, a downtrending market is a series of lower highs and lower lows, which we can see here. And a break of structure would be where change of character would be where now we can see that we're starting to make higher lows. We haven't really made at this point a higher high. We did test the most recent high, but now we are breaking that structure. So we have a change of character, higher lows and higher highs, and that could be the sign or the beginning of a new uptrend. But in terms of the big picture, and this is that subjectivity, right? We're still in a downtrend, right? Because we've made what? A high, a low, a high, and a low. And in a downtrend, where could we see that retracement to? And we said in downtrends, right, we could see a retracement that could go deep, and that would be around that 61.8 level. And that would be a target if I was looking for a long. But let's take this one step further, and this will kind of leave it on that. So here is that change of character, right? And let's do this. Let's take this price action, right? And again, right, let's do an extension. So here we went up, we reached our Fibonacci, right? So let's go all the way up here, and we're in this range here, and now we're basing in there. And where would that, where would those lines start to line up? Again, notice how the extension here. But let's do this. Let's say we base in this range, right? We based here for a while inside of the 23 and 38 retracement. Notice now, again, that's how relevant that 68 retracement is on the extension, right? The extension aspect. Okay, so there's where you're using both retracements and extensions, and they're showing the same levels where I need to be more respectful in terms of if I'm either long or a potential shorting opportunity. Okay, so I went a little bit long on this. I hope you guys enjoyed today's session. Again, if I didn't answer all of your questions, send them to support@barchart.com and we'll get to them. Gene, what else am I forgetting? Oh, I know. All of our sessions are archived, and this will be up there later today. There it is. Oh, there it is right now. And the slides that I had in there will be part of that. All of our sessions end up on our YouTube page. You can watch them there. If you're watching on YouTube, we appreciate a thumbs up and drop us a line and tell us what you liked about today's session. So I hope you enjoyed today's session. Okay, folks, until next time, the best of health, manage your risk, and the good of all trading.